Most people think that we need to have the lowest interest rates possible. And, it just stands to reason that if I can get a low interest rate, that means that it's actually going to save me money. All right. And if you go into this with a traditional idea, so we're going to go put a $350,000 mortgage in here. Okay. We're going to put 350. We're going to put it at 3%, okay, for 30 years. And here is how this thing is sold. When you hear this numbers, they're talking about having a loan for 30 years, okay? So the interest cost on this loan is $181,219.60. So the question would be the 181,000, 3% of the 350. Answer is no. It is actually 51% of that number. So already we're being charged a lot of money in interest that we'll have to pay over 30 years. But guess what, folks? Do you know that the average mortgage should be paid off in 7 to 9 years, not 30 years to never? And why do I say 30 years to never? Because 9 out of 10 people 9 out of 10 people that that ever had a mortgage never paid it off. You just count. I don't care how old you are right now. Think about it. The number of people that that ever had a mortgage, how many of them actually paid it off? It's going to be right around 10% of the people you actually know. That's it, national average. Okay. So here's what we're talking about. All the numbers that we're talking about is over 30 years. So what we're going to do is we're going to duplicate this tab and we're going to now change this to 4%. All right. Change the payment and we're going to compare the two. All right. Now the total interest paid is 251,000 as opposed to 181,000. And you say, well, Don, why would I want to do that? Remember, it's over 30 years. Now the payment is $1,670.95 for the 4% loan, and for the 3% loan is $1,475.61. So then why isn't the 3% loan better than the 4% loan? Here's why. Because you get a loan for one reason. I want to be able to pay it back. I want to be able to pay it back. So as we get ready to pay the loan back, what we want to do is pay it back in the way that it makes sense. So we don't want to just pay the loan off, folks. You have an interest component here, which means there's going to be an extra charge for paying back the money. When you borrow $350,000, there's not much you can do about that. But there's a whole lot you can do about how much you pay to manage the $350,000. So you want to put yourself in a position so that you can save the most amount of money you can with the funds you have available. How about that? Okay, so let's take a look at this. I'm going to break this down. I'm just going to use line 1 and line 2 to help us on the amortization schedule to help us to understand what's going on with this loan. So we have a 4% loan here, okay? And we're taking a look at payment number 1 and payment number 2. Okay, so payment number 1 on the 4% loan, $504.28 goes to principal. Now it's still a $350,000 loan, any way you look at it. And here's the interest cost, $1,166.67. So when we do this loan, we're going to subtract $504.28 from what we owe. We're left with $349,495.72. That's how much we owe. The bank uses this number to figure out how much interest we pay on the very next line. So it drops down to $1,164.99, and the difference goes over to the principal. So your payment is always the same. Your mortgage payment is always the same. It's just a different configuration each and every time, but it always adds up to the same. It's a little more that goes to principal, a little less to interest. A little more to principal, a little less to interest. But the payment remains the same. Okay, so now here's what we're going to do. We're going to find out what happens when we can control the interest cost, not the interest rate. we're going to control the interest cost on this loan. So $504.28 goes to principal. If this is January's payment, look at February's payment. All right. How much are we going to pay in principal in February when February rolls around? We're going to pay $505.96. Give this money to the bank, $1,164.99. But here's my question. If we make our payment in January, do we have to wait till February to give the bank this $505.96? The answer is no. If you had this money, you can actually pay it in January as well, if you had it. If you did, look what happens. You're paid down because all of this money goes to principal. You're paid down to line 2 in January, which means your next mortgage payment for February is actually on line 3 of the schedule. There you go. Look at that. Okay, line 3 of the schedule. And what happened to the interest on this line? It is completely and utterly canceled. You just canceled $1,164.99 in interest you never have to pay because you prepaid $505.96. So payment number 1 is now touching payment number 3, and we got rid of payment number 2 for only $505.96. Boy, oh boy, oh boy, what good news is that? Now, why is this important? Watch what I just did here. Remember, what do we have to do to get rid of payment number 2 at 4%? Give the bank $505.96 up front. Watch the same loan at 3% interest. We're going to scroll down. What do I have to do? Look at payment number 1. Look at payment number 2. What do I have to do now to get rid of a payment here? We've got to give the bank $602.11 to get rid of payment number 2. All right. But Don, look at the interest of $1,164.99. Listen, folks, interest costs I skip don't matter. The ones I skip don't matter. All right. Let me give you an example of that. So let's say you have a credit card that is 27%. Oh, my goodness. 27%, maybe even 30%. I've seen it as high as 32%. Credit card interest as high as 32%. So you charge something on that card, all right, but you pay it off before the due date, okay? So you charge it and they say, okay, now your due date is here, all right, and you owe us this much money. But if you pay off that card before the due date, do you owe the interest?
No.
So does it matter if it's 32% or 50% or even 100%?
It doesn't matter if you got your credit card from a shark out there in these streets. If you pay it in advance, he can't send his person after to come and get you.
There you go. That's what I'm talking about, folks. So interest costs you skip don't matter. All right. All right. So listen, folks, we just showed you that when interest rates start to rise, the principal payments go down and we can knock out more payments with our money if we're prepaying. Oh my goodness.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.